Welcome to the deep dive. Today, we're zeroing in on a real giant in finance, Mitsubishi UFJ Financial Group, MUFG.
That's right.
We've got their latest results, the year ending March 2025, plus some analysis on the risks they face and where they might be heading.
And a pretty detailed research summary, too.
Exactly. So our mission really is to pull out the key stuff for you, give you a clear picture of their financial health, the challenges, their growth plans, sort of a shortcut to understanding MUFG right now.
Yeah, we're digging into these documents to get you the core takeaways. And what's really striking, I think, is just the sheer scale of MUFG.
It's massive.
And how everything's so interconnected when you look at what drives their performance. We'll definitely look at the recent wins, but also, peek into the hood a bit, understand the trends, any potential bumps in the road.
Okay, let's unpack this. Let's get straight into the recent performance. Fiscal year ending March 2025. The big headline, 3 years straight of record profits. That sounds just plain good, doesn't it?
Well, on the surface, it absolutely does. I mean, look
Yeah.
at the key figures. Total assets hit 413.1 trillion yen. That's by March 2025.
Wow.
And net assets up to 21.7 trillion yen. That jump is mostly retained earnings profits they kept and these foreign currency translation adjustments, basically currency swings helping out.
Okay.
Operating revenue was 13.6 trillion yen,
Right.
recurring profit, a solid 2.6 trillion, which is up year on year.
Could increase.
And the net profit for shareholders, 1.8 trillion yen, also up compared to last year. And importantly, their cash flow from operations, positive. Investing activities, also positive.
Usually signals health, right?
Generally, yes. Financing activities were negative, which isn't unusual, maybe paying down debt or returning cash to shareholders. They ended the year with a huge cash pile, 109.0 trillion yen.
Those are just enormous numbers. But I see a note here. While net profit's up, their consolidated gross operating profit, that's the core banking profit, right?
Like their day-to-day banking stuff.
That actually decreased. That
Yeah.
feels a bit contradictory, what's going on there.
That's a really crucial point. It's fascinating, actually. The big boost in the overall net profit, it came significantly from things outside their main banking business.
Ah, okay. Like what?
Specifically, lower credit-related expenses. So fewer losses from bad loans.
Which is good, obviously.
That is good, yeah. And they also had gains from selling off some stocks they held. So the final number looks great, but the profit from their core lending and deposits, that actually dipped a bit.
So maybe some pressure on margins? Or strategic shift?
Could be either, or both. It's definitely something to watch. And it's also worth noting, their fourth quarter net profit specifically declined year on year.
Oh, interesting. Why the dip just in Q4?
That was mainly a strategic move. They reshuffled their bond portfolio, sold some bonds, took some losses.
Okay. Setting themselves up for something. Interest rate changes, maybe.
Very likely. Positioning for the future. But it hits the quarterly number in the short term. Still, despite that Q4 dip, analysts generally remain positive. Ratings are around, 4.2 out of 5?
Pretty decent.
And their recurring profit actually beat the consensus forecast, the IFIS consensus, by about 3.5%. So, there's still recognized strength there.
Okay, so strong overall, but need to look beneath the surface. Got it. Now, how solid is their footing? Financial soundness, capital reserves.
Right, soundness. MUFG looks pretty strong here. Their equity capital ratio, based on international standards, was a healthy 18.83% at the end of March.
Okay.
And crucially, their CET1 ratio, that's Common Equity Tier 1, a key measure regulators watch closely.
The safety cushion.
Exactly. It's right within their target range. It means they have a good buffer of high-quality capital to absorb potential losses. Keeps regulators happy, boosts investor confidence. It's vital.
Good to know. Now, a big question for many, shareholder returns. What's the story? Dividends, buyback.
Definitely moving up. They increased the annual dividend for the year ending March 2025 to 64 yen per share.
That's a big jump from 41 yen the year before.
It is. And they're forecasting another increase to 70 yen for the current fiscal year ending March 2026. Their dividend payout ratio, the slice of profit paid out, is a solid 40%. Plus, they did a share buyback in the first half of the year, up to 250 billion yen worth.
Buying back shares, usually a good sign. Boosts earnings per share, signals confidence.
Typically, yes.
But I see another note. Some analysts were, underwhelmed by the buyback size. Why is that?
Yeah, that's interesting, isn't it? It shows how expectations work. I mean, 250 billion yen is a lot of money.
Sure sounds like it.
But connected back to those record profits and strong capital levels, some analysts probably thought, hey, they could do more.
Ah, they had capacity for a bigger buyback.
Potentially, yeah. Maybe they wanted a more aggressive return of capital, especially if finding high return investments is tough right now. So even good news gets viewed differently.
Right. Market expectations. Okay, so generally positive on returns, but with some nuance. Let's shift gears. Potential challenges, risks. What's MUFG facing?
This is really critical. First up, always is credit risk. The risk borrowers default.
Standard banking risk.
Standard, but always changing. Now, their non-performing loan ratio actually decreased in March 2025, which is positive.
Yeah.
But there's still uncertainty. Think about the economy, the Russia-Ukraine situation, trade policies. These could all strain borrowers.
Makes sense. Geopolitics creates economic waves. What else?
Market risk, big one. Fluctuations in interest rates, currencies, stock prices.
Yeah.
These directly hit the value of their investments or swap transactions.
Yeah.
Interestingly, they figure a 1% rise in interest rates could boost their deposit revenue by like 200 to 300 billion yen a year.
Wow, that's significant.
But it's a double-edged sword. Rising rates can also mean losses on their bond portfolio. They even estimated an 80 billion yen profit increase this year just from a tiny 0.15% policy rate hike.
So rate moves are a big lever both ways. You mentioned geopolitics for credit risk, but it sounds like a broader worry too.
Absolutely.
Yeah.
The growing split between nations, rising tensions, U.S.-China, Russia-Ukraine, Middle East instability.
Yeah, it's a lot.
Plus trade policies from major countries. All this could mess with supply chains, raise raw material costs. That has a knock-on effect on the global economy, markets, and MUFG's customers, especially in Asia, which is key for them.
Right. And cybersecurity, always huge for banks.
Precisely. It's a top-tier risk,
Yeah.
constantly evolving. Attacks are getting smarter, AI, ransomware, you name it.
The potential damage is enormous. Financial, reputational.
Exactly. So they're countering hard. Strengthening systems, they have a dedicated response team called MUFG CERT, using security evaluation platforms like Assured to find weaknesses proactively.
Sounds necessary. What about competition? It feels like finance is getting crowded.
It definitely is. They face heat from digital banks, SBI Shinsei, Rakuten Bank here in Japan, plus tons of fintech startups chipping away at things.
And the other big banks too, right?
Oh, yeah. Head-to-head competition with other mega banks, especially in growth areas like wealth management and, again, that Asian market. It's intense.
And regulations. They never stand still for banks.
That's for sure. Another risk layer. You've got stricter capital rules coming in. Basel III continues to roll out, tighter data regulations, and growing pressure from regulators on ESG disclosure and climate risk management.
ESG, environmental, social, governance, big topic.
Huge. Staying compliant takes a lot of resources and focus.
Lastly, our notes mention internal challenges.
Yeah, a couple of things. One is just the risk of executing their big midterm plan.
Mm.
It's ambitious. Rolling it out across such a huge global group is complex.
Lots can go wrong.
And they also need to keep strengthening governance and compliance, especially after, some past incidents with customer information handling. Trust is everything in this business.
Absolutely critical. Okay, that covers the risks well. Let's look forward now. Growth strategies, future outlook. Their midterm plan for 2024-2026 seems central.
Exactly. The theme is taking on growth for the next 3 years. It's built on 3 pillars: evolving growth strategy, solving social issues, and accelerating corporate transformation.
And some big targets.
Oh yeah. For March 2026, net profit of 2 trillion yen. ROE, return on equity, TSE definition around 9%. Operating profit of 2.1 trillion, that's a 30% jump from FY 2023. And keeping that CET1 ratio between 9.5% and 10.5%. Ambitious stuff.
Definitely ambitious. Let's break down those pillars. Pillar 1, evolving growth strategy. What's the plan, especially domestically?
Domestically, it's really 2 main pushes: retail banking and corporate wealth management. For retail, it's all about maximizing customer lifetime value LTV.
Okay, how?
Through a mix of channels: physical branches, remote support, and digital platforms. They want like 10 million monthly active users on their digital channels and 100 trillion yen in customer financial assets. Big goals.
Huge goals. And corporate and wealth management.
There, the focus is strengthening solutions for things like business succession, asset transfers for owners. They're leaning on Morgan Stanley's expertise here.
Leveraging that alliance.
Exactly. Targets include 1 trillion yen in succession-related loans, 88 billion yen in operating profit from this area, clearly targeting businesses and wealthier individuals. And generally trying to boost non-interest income fees from asset management, wealth advice, that sort of thing.
Okay, so hitting both broad retail and high-value segments at home. What about globally? Asia seems like a major focus.
It really is. They call it their second mother market. That tells you how important it is.
Right.
Strategy revolves around partnerships. Kronzri in Thailand, Danamon in Indonesia, and they're building this thing called MODE.
Mo.
MFG, Openly Connected Digital Ecosystem, basically a digital platform to link financial and other services across Asia. They want over 10% ROE and 600 billion yen operating profit from Asia. The core idea is Asia X Digital.
Tapping into Asia's digital boom and the Morgan Stanley Alliance. Still key globally.
Very much so. They call it Alliance 2.0. Deepening cooperation in FX trading, Japanese stocks for institutions, investment banking, wealth management.
Aiming high.
They want to be a top-tier securities player in Japan via their joint ventures. And those ventures are getting good customer satisfaction scores, so it seems to be working. Beyond that, their global CIB and markets businesses are integrating more to boost capital efficiency, aiming for over 8.3% ROE. And in the Americas, after selling Union Bank, they're focusing more on corporate deals.
Okay. Pillar 2, solving social issues. How does a bank tackle that? Sounds broad.
It is broad, but it mostly centers on sustainability. ESG, or GX Green Transformation, as they sometimes call it.
Right, GX.
Big target, 100 trillion yen in cumulative sustainable finance by FY 2030. Half of that for environmental projects. They're actively helping clients with their own green transitions, aiming for 50 co-created GX projects.
So financing the green shift.
Pretty much. They have 10 priority issues under themes like sustainable society, vibrant society, resilient society, and net zero goals. 2030 for their own operations, 2050 for their lending portfolio. They're backing things like biomass power, biodegradable plastics, childcare businesses.
Shows a real commitment. Okay, pillar 3, accelerating corporate transformation. What's involved there?
This is really about making the whole organization ready for the future. Digital transformation DX is a huge part.
AI, data.
Exactly. Investing heavily in AI and data infrastructure. For better decisions, better customer value, better productivity, they want over 300 AI projects running, 20,000 plus users of their BI tools. They're even rolling out ChatGPT group-wide.
Interesting.
The aim is better digital services everywhere, digitizing products, using tech to cut workload. They're using their bank platform, too, that's banking as a service.
Letting other companies use their banking services.
Right. But it's not just tech. It's also about culture being more agile, innovative, developing talent, strengthening risk management further. It's a whole organizational push.
Sounds incredibly comprehensive. A lot to execute. So if we were to quickly summarize with, say, a SWOT analysis based on all this, strengths, weaknesses.
Sure. Strengths: massive customer base, global network, strong brand, group synergies, bank, trust, securities, solid capital. That Morgan Stanley alliance is a big plus.
Weaknesses.
Domestic market is mature, slow growth, maybe not the fastest adapter sometimes. Execution risk on all these big plans, especially DX. And those past compliance issues linger a bit in terms of needing constant vigilance.
Opportunity.
Interest rates normalizing could help margins. Wealth and asset management are growth areas. Asia, obviously. Getting more out of the Morgan Stanley link. DX itself is an opportunity. Leading in sustainable finance.
Those threats.
Global economic slowdown is always a worry. Geopolitical tensions, as we discussed, intense competition, cyber attacks ever present, tighter regulations, and again, the risk. They just can't pull off the ambitious midterm plan smoothly.
Okay. So it really feels like MUFG has this compelling growth story they're building. Strategic initiatives, maybe some tailwinds like interest rates, but balanced against some pretty significant global and execution risks. Getting that ROE target seems crucial.
That sums it up perfectly. It's that balancing act, isn't it? Using their strengths to chase opportunities while trying to mitigate the weaknesses and navigate those external threats. It's a complex picture.
So wrapping up our deep dive on MUFG, the key takeaways really are strong recent performance, yes, but boosted by some non-core items. Ambitious growth plans, Asia, wealth, digital are the big themes. But all this against a backdrop of pretty serious risks, economic uncertainty, geopolitical instability, cyber threats. It's a challenging environment.
It is. And as you watch MUFG going forward, you'll want to track their progress against those midterm targets. How do interest rate changes actually impact their bottom line? How's the Asia strategy, that MODE ecosystem developing? What concrete benefits come from Alliance 2.0? And how is the DX and sustainability push really translating into results.
Those are the key things to monitor.
Absolutely, those will tell the story.
And maybe a final thought for you, the listener. Think about how a massive institution like MUFG juggles this tension, pursuing ambitious growth in new areas while managing incredibly complex global risks. What does their approach, their successes, maybe their failures, tell us about where the whole financial industry might be headed in this interconnected, rapidly changing world?
It's a fascinating question about the future of finance itself.
Indeed. Thanks for joining us for this deep dive.